Aapl, AAPL, is consolidating above the 21-day moving average and showing solid relative strength compared to most other tech stocks. AAPL is rated a buy and the Barkhart technical opinion rating is a 64% buy with an average short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. Rather than just buying the stock, savvy traders can use the options market to find smart ways to trade Aapl stock without risking too much capital. Today, we're going to look at a couple of bull call spread trades with different expiration dates. Here are the parameters for finding some bull call spread trade ideas on AAPL. Symbol equals Aapl. Probability above 40%. Moneyness minus 5% to 5%. Days to expiration 30 to 150. Let's analyze some of these ideas. Bull call spread 1, May 170 to 190 bull call spread. As a reminder, a bull call spread is a bullish defined risk option strategy. To execute a bull call spread, an investor would buy a call option and then sell a further out of the money call. Let's use the first line item as an example. This bull call spread trade involves buying the May expiry 170 strike call and selling the 190 strike call. Buying this spread costs around $8.55 or $855 per contract. That is also the maximum possible loss on the trade. The maximum potential gain can be calculated by taking the spread width, less the premium paid and multiplying by 100. That give us 20 to 8.55 x 100 equals $1,145. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 133.92%. The probability of the trade being successful is 40.7%, although this is just an estimate and does not indicate the probability of achieving the maximum profit. The spread will achieve the maximum profit if AAPL closes above 190 on May 20th. The maximum loss will occur if AAPL closes below 170 on May 20th, which would see the trader lose the $855 premium on the trade. The break-even point for the bull call spread is 178.55, which is calculated as 170 plus the $8.55 option premium per contract. Bull call spread 2, July 170 to 180 bull call spread. The next example involves buying the 170 July call and selling the 180 call. Buying this spread costs around $5.30 or $530 per contract. That is also the maximum possible loss on the trade. The maximum potential gain can be calculated by taking the spread width, less the premium received and multiplying by 100. That give us 10 to 5.30 x 100 equals $470. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 88.68%. The probability of the trade being successful is 46.5%. The spread will achieve the maximum profit if AAPL closes above 180 on July 15th. The maximum loss will occur if AAPL closes below 170 on July 15th, which would see the trader lose the $530 premium. The break-even point for the bull call spread is 175.30, which is calculated as 170 plus the $5.30 option premium per contract. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. For a bull call spread, setting a stop loss of 50% of the premium paid is a good idea. In the first AAPL example above, that would be a loss of around $575. For the second example, the stop loss would be around $265. Trader may also consider a stop loss if AAPL breaks below the 21-day moving average. Aapl is due to report earnings towards the end of April, so some traders might prefer to close the trades before then.